Hi friends, I'm back with one more video. So today we will be discussing about all the myths of adjustments. Basically what happened is, so whenever I'm just sharing all the videos, I am getting all the comments from different retailers on the adjustment. So let's say they'll ask what to adjust, when to adjust, why to adjust. I mean, see, this all the adjustment itself is a very subjective topic. So what I thought is, like, rather than me replying to each and every one's comment, so I thought of making a video. uh, so basically what I do is, like, whenever I come up with a video, so if I see any common issue between any of the retailers, so what I planned is to come out with the video. So let's today discuss about the myths of adjustments. This is going to be like very interesting video. I think for a few this would be like eye opener video. Okay, so now why do we actually go for adjustments? Friends, before I answer that question, please ask that question to yourself. Why exactly we are going for adjustments? So if you have that answer with you, well, you are a very smart trader. If you do not have that answer, you are doing something wrong in the market. If you look at majority of the retailers, they say, okay, I go for adjustment to mitigate my loss. Simple, to mitigate my loss, I go for adjustment. Right? This is the only one thing which they know. But friends, this is only 50%. Alright. So the other 50% is, even we do the adjustment to lock our profit. This is very important, to lock our profit. Okay. So we go for adjustments to mitigate the loss and also to lock the profit. This is your complete adjustment. Someone call like adjustments and someone will call it as shifting. So there is a difference between adjustment and shiftings, but we will just put them into one bucket. When you can say adjustment, so basically we go for adjustment whenever we wanted to mitigate the loss. So let's say you have your Ironfly, let's say Straddle. Let's take an example of, you have a Straddle, market is standing somewhere here, all of a sudden the market came to a break even. Now this is a panic situation. So now you will not even look out for the profit, you will look out to mitigate your loss. So either you will shift your straddle, so then all the adjustments comes into picture. So I'll not discuss about any particular adjustment, I'm just telling you, because this is your testing site. So you'll not even think about profit, you'll right away do the adjustments because you have unlimited loss, so you want to mitigate your loss. All right, now what is why adjustments? We have discussed to mitigate the loss and also to log the profit. Let's say the classic example would be, let's say you have a Ironfly. This is your Ironfly. Day 1 Thursday market stands here. Okay, next day Friday the market makes a move of 2%, sorry 1%, and then it comes in between again, it makes a 0.5%. Finally your market ends on Friday at let's say at the same point. You are in the middle of the straddle. So what you'll do the reverse buying. The moment you do the reverse buying, you are mitigating your loss. Point number one, you are mitigating your loss because you'll do the reverse buying from call side and also from the put side. Let's say Monday market stands flat as it is. Again you will do the adjustment, right? You will be able to mitigate the loss. Let's say on Tuesday also market stands flat. So now your Ironfly will become like this. You will do the adjustment, your Ironfly will become like this. Initially it was loss, but now by doing 3 roll shiftings, 3 roll up and 3 roll down, because market is standing in the between, then this is your profit area. So you have done the adjustment not only to mitigate your loss. Initially you have mitigated your loss with 1 shift, 2nd shift and 3rd shift. Your Ironfly will become, this is profit not loss. Friends, see, there is a huge difference between this Ironfly and this Ironfly. Check the bottom line. This bottom line is wrong. This is your loss area. But check this Ironfly. You have shifted and then you made your Ironfly profit from both the ends. Alright, so adjustment we use for mitigating the loss and also for locking the profit. So now the moment you make your trade free, you have locked your profit basically. So you have locked your profit on the downside, on the upside and also in the middle. All right, now What adjustments we have to do? Stay with me, friends, stay with me. This is going to be like what adjustments we need to do. So I come across with so many comments saying that what adjustments we need to do. I'll take you away, I'll take you to this video, so wherein I've made a video, right? We have these many adjustments, so now I'll just leave it to you. We have something called reverse buying. Okay, let me take the black pen. We have reverse buying. You can sell extra options from opposite side. You can sell extra options from opposite side and shifting the buy leg. This is combination of your extra selling and by doing this sort of reverse buying. Right, this is, see, when I say reverse buying, this is on the testing side, right? Even we can just call it as a reverse buying. Then you can buy the options as one of the adjustment. You can go for deploying the calendar edge. You can shift the straddle, which this video is pending from my side. You can deploy your broken wing fly. You can deploy your ratio spread to get additional points on the your testing side. You can just go for broken wing fly. You can also go for ratio spread. You can just, the other adjustment, you know, right? Whenever you have your trade on Wednesday at 3:20 and Thursday at 9:30 am, you can do one more adjustment to get the extra credit, right? You can just, I've made one more video, right? You can just do the adjustments by balancing the positional delta difference. So these are all the various adjustments. Now I'll just leave it to you. You should not ask this question. If you are watching all my video as a video but not doing any hands-on experience, you will not get to know what adjustments I need to deploy when. If you have the view of the market, if you know what is the view of the market, where is the OI build up getting developed, what are the FIs doing. So if you combined all your price action with the OI built up with other parameters, right, so you'll be able to do the adjustments. So let's say this is your Ironfly. I'm just giving an example. Let's say this is your Ironfly. Market was here. The next day market came to your break even, right? But still you are saying that maybe you have a very strong resistance, right? Market was somewhere here, right? Market is standing at the resistance, right? You have a strong feel that maybe market will come, it will take a retest. So then what can you do? You can just deploy a broken wing fly here, so that will give you safety of 2 to 300 points on the testing side, and also you have a strong belief that market will come down. If market again comes down, again you'll be able to end up trapping the market into green zone. So I'm not discussing about all about the options, about the adjustments. I'm just giving you an overall view, right? Let me take you back to the PPT, right? We have discussed about what adjustments we need to do. So you got right. So you need to be like aware of all the adjustments, right? When to do the adjustments, this is going to be like very subjective topic, friends. This is where you need to be like when to adjust. This is going to be subjective, and let me take you directly to Obstra. See, let's say if I've shown made a video by saying that Ironfly, this is my Ironfly. Market was standing here, market, the next day market came here to a break even, then I started selling a naked put option from my break even. Alright, so now people will ask me, when should I exit this extra put selling? Simple, friends. The moment you buy a naked sell, you're limited. This will become unlimited loss, right? This will become unlimited from limit, because we are one sell extra. This will become unlimited. Your market stands here. If market keeps going up, you will get good profit in this naked put position. But if market makes a U-turn, if it goes to straddle, or else if it is below your straddle, people will start asking me, when should I exit this naked put? This is very subjective. I'll just explain you, because this is very subjective. There are like too many things into consideration. First of all, which day you are referring to. Let's say you have deployed your trade on Thursday, right? Are you referring from Friday or Monday, right? Tuesday or Wednesday or Thursday? Which day you are referring? All your adjustments depend on the day. See, if you are on Thursday, on Friday, if you are into this position, right, you have to do different adjustment. I'll show you all the practical example. Let's say you are on Monday. The kind of adjustments you thought of doing on Friday, that would not work for Monday. The kind of adjustments what you plan to do on Monday, that will not work for Tuesday, right? The same will not work for Wednesday. The same will not work for the expiry day, because there is something called theta. There is something called theta, right? The more the option seller retains the trade, the more theta benefit you'll be getting. So everything will depend on the theta. So rather than me telling you all the theoretical, let me take you directly to abstract to sensible. Friends, try to understand this logic. So let's say this is not specific to any strategy. I'm just taking the ratio spread because ratio spread is a unlimited loss strategy. Simple, friends, this is a unlimited loss strategy. Let me take the black marker, right? This is your ratio spread. Let's assume you have deployed this ratio spread on Monday. I'm just doing this video today after the market close hours. Today is Friday. Let's say you have done this, you have deployed this trade on Friday. Now this has the unlimited and this has a limited profit. Okay, now people will ask me, right, I have the unlimited loss on the call side, all right, because you have two sold positions, one and two sold positions, and you have only one buy position. So this is 1:2. You have one buy and two sold positions. Simple, friends. If you have more sold positions than your buy position, that will give you unlimited loss. Let me show you. Right, this is going to, if I deselect this thing, this will become limited loss and limited profit. This is your typical debit spread. Do not go on this strategy. I'm not discussing about the strategy. I'll just try to tell you how the adjustments are dynamic. All right, now when I select this thing, right, this is your trade. Now someone will ask me, when should I exit this leg? 34,400, because this is giving me the unlimited loss, right? The moment I exit this leg, this will become your debit spread. The loss will be limited, only 5,000 on the downside. But the question is, yes, I've deployed this trade, when should I exit this leg? This is going to be like very subjective, meaning this all depends on which day. Point number one, what is the VIX? Where is the VIX standing? I'll keep stay with me, friends. I'll explain. Right, what day, how close or far you are from your expiry. Are you very close to your expiry, or you are on Thursday, I mean on the day, on the deployment day, or you are on Friday, or you are on Monday, Tuesday, Wednesday, Thursday, Friday? This is going to be like, and what is the VIX? Point number two, this is one, how close or far you are from your expiry, where does your VIX stand, and third thing would be your view of the market, which is very important. View of the market is important. You should know where is a support or resistance, your immediate support 1, support 2, support 3, immediate resistance 1, resistance 2, resistance 3, and then fourth, if you can just combine it with OI analysis, your open interest, plus if you can just have your FIS, what are the FIs doing, whether they are selling or buying. See, when I say when they are selling, market will be bearish, so based on that you can do your adjustments. When they are buying, the market will be bullish, so based on that you can just combine. So this all four parameters are must for adjustments, and these four parameters differ from each day, friend. Stay with me, I'll just explain you with all the practical examples. So anytime if someone asks you what adjustment I have to do, so before you ask that question, you have to tell the boss, I am on Friday, my trade is a strangle or a straddle, okay, or else I am on Monday, right? I have minimum loss of 3,000 on downside, and I have my unlimited loss on the call side. So what adjustments I have to do? So based on that, someone can help you. But if you say that when to do these adjustments, how to do these adjustments, no one can help you until and unless you give them all these details, right? Even I get so many what do we say, the messages from my friends saying that, see Ravi, have deployed a triangle, they'll give me all the strike rates, they'll not even share the payoff. See, for me this payoff helps me. If I have this payoff, at least by looking at the payoff I can say, okay boss, your call side looks very risky, you're safe on the put side. They will just give this number 33,500, I bought this. Why I'm not, see, we are end of the day humans, we cannot calculate everything. That's the reason we have this option for us, right, to make our job easy. So I'll show you one practical example, right? So friends, let's say you have deployed this trade on 10th sorry, on Friday, right? What I'll do let's say this is your, let's say the market is running, let's just visualize the market is running. This is Friday at maybe 12 o'clock you have deployed or 11 o'clock you have deployed. The moment you deploy, you should know from where your loss will start. Okay, what I'll do, I'll just simulate the markets here. I'll just go to 1%. Friends, this is going to be like very important video, right? So now you have a loss of 576, right? The moment market goes 1%, you have a loss of 576. For the reason being, I've told you many times, you have to take the help of this blue line. Your loss will start from here, friends, the moment the intersection somewhere here, because the blue line is intersecting. Okay, let me delete this thing now. Let's stay with me, friends, stay with me. Okay, so your loss will start when the market makes a move of 1%. You will have minus 576 loss. Now what will happen if the market stays at the same position on Monday? Alright, so now you have a loss of 576. So I'll say, okay, if someone has a trade on Friday, I'll ask them to do the adjustment at maybe here 33,880. Do your adjustments before, because I would rather say not, I would rather say do your adjustment somewhere at here, because your loss is 33. The moment the market is at 33,700, the moment your loss starts. Or else if you have something in your mind saying that okay, I'm okay to take the 500 loss, so then you can do your adjustments at 33,880. Point number one, stay with me. Now this is for Friday. If someone is asking me on Monday, so what I'm just doing, friends, see, I'm just taking this Friday, right? I'm just manipulating, I'm taking it to Monday. Now your loss is 576, friend. Market is standing at 33,880. I'll just take you to Monday, because Saturday and Sunday are off. Saturday, Sunday, and then check this loss, right? And check this blue line, friends. This is very important. See, when I'm clicking on this thing, you should focus on this loss and on this blue line. Rather, I would say focus on the blue line. How the blue line will, from steep downwards, it will become somewhat flat, and it will try to cover this green area. Okay, I'll just go to Monday. Now straight away check the blue line. Check now. You will be at a profit of 2,200, the projected profit. On Friday you were at loss of almost 600, but now you are at 21. If someone asks me when should I do the adjustment, now what I'll say, okay, this is Monday, right? Now this is Monday, right? You are safe till, simple, friend, this is magic, right? You are safe till this black point, I mean this line, because your blue line is above your zero line, this vertical, this horizontal line. The blue line is above this zero line, and from here it is coming down your zero line. You got my point, right? So now I would say, boss, do not do the adjustment until market makes a move of, see, 2.74%. When market makes a up move of 2.74% on the intraday, on the Monday, you start doing your adjustment, right? But on Friday I told to do the adjustment here at 33,880, because your blue line was very steep. But on Monday, right, you will get the theta. See why the blue line has all of a sudden from steep downwards, it is giving you extra range, because of this Greeks, friends. Just try to understand, because you are getting this theta benefit, right? This theta, the blue line will act as a, that's what I keep telling, like blue line is must for all the option seller, right? Let me show you, right? Now you have to do your adjustment at when the market makes 2.5% up. Now let me take you to Tuesday, right? At this point we were at the profit of 2,191. If someone says, boss, I want to do the, when exactly I need to do the adjustments, I'll take you to Tuesday. Stay with me, right? Tuesday your profit has increased to 3,225. Market is standing at the same position. I'm just taking for the demonstration. Market is standing at, but your profit has increased. Now if someone asks me, boss, where should I do the adjustment? This is your Tuesday, right? Your adjustments keep changing. Hope you're getting my point, right? I'll delete this thing. Now I'll say you do the adjustments only at this point, or maybe I'm just giving this point, because this is where your blue line is breaching your zero line. Okay, now let me show right, what is that? At 3.4% you have, see, initially it was 0.5% on Friday. Monday it was like almost like 3 maybe 2.5%, and now Tuesday you have to do the adjustments only when the market makes a up move of 3.10%. Your loss is 10 rupees on Tuesday. This is where I stress to all, I mean, I keep telling to all, adjustments are very dynamic. You cannot ask someone what adjustments I to do. When should I do the adjustment? There is no straight answer for it. Adjustments depend on many factors like how close or far you are from the expiry, what is the view of the market, what way does the VIX stand, and all these factors. And also, see now, let's say I'll delete this thing. Now, Tuesday, if someone asks me on Wednesday, market stands here, your profit has increased, see the profit trend. Now, if someone asks me when exactly I need to do the adjustments, I would say, see now you got my point. I would say your this thing, your loss will start at somewhere here, meaning you are getting a, a range of, you have to do your adjustments only at 3.52%. Friends, stay with me, try to understand, right? I'm just trying to show you all the real-time example. You have to do your adjustments only at 3.5%. So then you see 3.5%, you have a loss of only 219. All right, and let me take you to Thursday. Right, if someone asks me, right, Thursday almost, see, I'll take you to 3 p.m. right, this is almost like let me take you to 1 p.m. 1:30. Now if someone asks me when exactly I need to do the adjustments, see you got my answer, right? Now you have to do your adjustments only when, I'll show you when is your loss starting, almost at 3.7%. You got my point. 3.7% you have to start doing the adjustment. So what did we I mean, what is the conclusion basically? I'll again take you to this page. What is your conclusion basically? Conclusion is, okay, when to adjust is subjective. This is very subjective. So again I'll reiterate, how close or far you are from expiry, number one. Your view of the market, all right, and then where does the VIX stand? Even VIX will play an important role, right? And your other analysis like your OI and your other analysis, which will complement your market view. All right, so let me again take you back to this video. Let me delete this. Now let's say I'll just get it back to Friday. Let's say I'll just get it back to Friday, friends. Again I'll demonstrate. So on Friday, you let me reset the price, right? Let me reset the price. This is your original, okay, sorry, let me reset the price. This is your original trade. Okay, so now if the trade on Friday, if the trade went like 2% up, you have a loss of 2,407. All right, now on Monday what happens? If I take you to Monday, what will happen? You from 2,300 loss, you're straightforward, I mean straight away getting into profit because of your blue line. You got my point? Next day morning, you're into 3,300 profit because check the blue line. Blue line is right from the steep, it is going steep but on the upward. Wednesday, check the blue line. See, and Thursday this will, see now Thursday you have this blue line. So if I go to 330, you'll not even see that blue line because that will cover your entire zone. 330. Simple, friends. This is what I mean to say. Adjustments are very dynamic. There is no, so whenever I'm showing one adjustments, let's say I'm just demonstrating one Ironfly. So if I've done the reverse buying on Monday, that doesn't mean that the same adjustment you have to do it on Tuesday, Wednesday, Thursday, Friday. That's what people tend to buttify it. See, do not buttify. You have to understand the blue line. Take the blue line into consideration. Blue line will give you, see, that's what I'm telling you. See, no one gives importance to the blue line. See, blue line will give you, right, a strong indication. See, let me zoom this out. You'll get to know. Let's say I've deployed this trade. My blue line says, see, boss, you will get your loss from 213. Let's say 213. So before I get into loss, I'll straight away start doing my adjustments like 50 points before. because my blue line is giving a strong indication your loss will start from here, or else let's say if I'm okay to take 1000 loss, right? If I'm okay to go okay until this area, right? From this 34,000 your loss will start. So I'll just put a alert in trading view. The moment the market touches 34,000, just give me an alert, show me an alert. Based on that, what I'll do, I'll just do the adjustments. But this adjustment what you're doing it on Friday doesn't make any sense you if you're doing the same adjustments on Tuesday, because on Monday at this position you'll not have the loss, right? When the market stands here, your loss will there will be no loss. See, again I'll show you, right? We are at 2 rupees loss, right? Let's see, when the market opens on Monday, you are at a profit of 1243. Check the blue line. So now you have to do your adjustments only here when the market makes a move of 2.57. Put an alert until and unless your market hits 34,400. Do not even think to do any adjustments. Okay, I'll show you one my real trade. This is my real trade, friend. This is my real trade. If you look at my sensible, this is my Ironfly. I've done all the adjustments. So let me take you to Friday. I'm on Friday, right? Let's say this is my Ironfly, right? Now I wanted to sell a put. I wanted to get some extra premium from let me reset. The market stands here. Market is standing in where I wanted to sell some extra put. Okay, I'll go to option virtual trade. What I'll do, I'll try to sell some 72 rupees or 60. Okay, I'll try to sell this. Simple, friends. Now the moment I sold this, now see, this was limited. When I sold one put, my loss on the on the put side is unlimited. Yes, obviously, because you have one extra sold. Now when should I exit from this leg is the biggest question, right? When should I exit? This extra sell is biggest question. Now the blue line will give you an indication. Let me zoom this out. The blue line will give you an indication when you have to exit your loss, because if you look, this is where you have to exit your extra sell position. For the reason being, your blue line is steep here. Okay, let me show you what loss you will get. Alright, so let me see. Just keep a note on the black box. See where your loss will start. Your loss will start from here. The moment the market makes a minus 0.65. Now let's say market stays as it is. It did not get any chance to do because market was flat, right? You were not supposed to do any adjustments until and unless market makes it, because you are at profit now. Let's say Monday market opens at the same area. Again I'm showing with my real trade frame. Let's say Monday, this is Saturday, Sunday and Monday. See, you are straight away with a profit of almost 3000. Now where should you do the adjustments? Now you have to do your adjustments at almost this position and check the range. Initially it was 0.65%. now check the range. You have to do your adjustments only when the market makes a almost 2% downside movement. See, 2% downside here. Now you'll see the loss 2.20%. If you go to Tuesday, this will increase, your range will increase. See, your profit will increase, your range will increase. I think I've pretty well covered about this thing, when exactly you need to go for the we have covered about this point, right? Why adjustments, right? You should know the definition of adjustments and shiftings. What adjustments we need to do? There are tens and hundreds of adjustments. You have to be very clear with the market. So based on that, you have to opt for all those different adjustments, or else you can combine 1, 3, right? Adjustment number 1, what I've shown it here. What did I show it here? See, all these adjustments. You can combine 1 with 4, or else with 3, 5, 6. Just to give me some example. You can combine 1 with 4 and 8. Right? I'll just leave it to you. Okay. Now let me take you back to myths of Ironfly. Right? We have discussed about this thing. Now, one of the important. Let's say you have deployed a straddle or a Ironfly, right? Or let's say strangle. Now whenever you deploy, so let's say market stands in the middle, your market stands in the middle, your market stands in the middle. If market gaps down by let's say 3%, if it comes to a break even, market gaps down and it comes to a break even, market gaps down and it comes to a break even, right? Do not even think to do the firefighting, especially when the market is falling down. When the market falls down, the premiums will increase like anything. So do not even dare, do not even think to do the firefighting, doing your adjustments when the market is falling, because when the market falls, the VIX will increase, the rising VIX will increase the premiums of your sold position in a very wild moves. You will start seeing all the losses. So rather than doing firefighting, exit the entire trade, exit the entire trade, exit the entire trade, and then go for a new strangle, go for a new straddle, go for a new ironfly. Reason being, you have to understand, reason being, when the market has fall, the VIX has increased. If the VIX increase, you will get high premiums, you will get high premiums. So high premiums will help you in terms of getting high range in your strangle, okay, and then high range in your straddle, and also high range in your ironfly. Accept the loss, even it can be 2000 loss for your for your ironfly. This can give you 5000 or 6000 because this is a naked. This can give you 5 or 6000 because this is naked. But accept the loss, accept the loss, and deploy a new strangle or straddle or ironfly, because you will get more premium. Because if the market falls, the VIX will increase, the rising VIX will increase the premium. The I premium is I range, I range is I POP, right? I range is I profit. Both POP will increase, your profit will also increase because the range is I. Alright, let me delete this thing. And now there is a myth in market saying that we cannot do intraday. Boss, we can do intraday. See, adjustments are not always all about when the market stands here or when the market stands here, right? You have to start selling from the opposite side. You have to start selling from the opposite side. Let's take an example. When the market, right, almost comes here, not to a break even, maybe comes to your close to your break even, and then slowly it starts coming, right? So it is not compulsory that you have to sell the calls. You can just buy the put also on the intraday basis. This works like magic, friends. You have to, as an option seller, you have to buy the put here rather than selling a call, because you know, right, market is falling. Simple to understand this, market is falling, VIX will increase. Increasing VIX will support your buy legs, not your sold legs. Increasing VIX will increase the premium of your sold legs, but increasing VIX will increase the premium of buy leg, and that's what we needed. As a buyer, we need the premiums to increase, right? Whenever the market is at your break even or about to go to your break even, think to do the intraday. I mean, you have to buy the options on the intraday. If you are getting good profit on the intraday, exit that buy leg at 320, or whenever you see a very decent profit, right, exit the buy option whatever PE you bought. Because if the market stays sideways or if the market goes up, whatever profit you got in your intraday, that will decay like anything. That's what you have as a buyer. You have to just exit the entire profit and think to do one more option buying, but just exit your trade with a profit, and then you can, based on that, you can just try to buy one more intraday option. But do not what do we say, take this intraday options buying to overnight. I've already discussed many, and one of the biggest common myth in market. So if I ask you what is the threat for an option seller, if someone can answer, there might be many things, but one of the biggest thing, what is the threat of option seller? Just pause the video and just try to answer it. If you have answered it right, I mean, you are a very smart trader. See, basically the threat of the option seller is simple, friends, gaps. That's it. Gaps is the threat of the option seller. It can be gap up or it can be gap down. That's it, friends. One of the biggest enemy of option seller is your gaps, because that is not in our control. Let's imagine the market runs 24/7. Let's imagine, friend, the market runs 24/7. So do you see any of the option seller making a loss? We cannot make the loss. Let's say the market is going in one direction. Let's say you have a strangle. let's say you stand somewhere here, market is going up. What will you do? If market keeps going up, you will roll up your put. If the market is again going up, you will roll up your put. Let's say if the market again comes down, you will again, what do? You will roll down your call. Right, again if market suddenly goes up, right, you will exit this call, you will increase the range. I'll make a video, friends, how to increase the range of this triangle. That is going to be a very important video for you. So basically what I mean to say, like, if the market is running 24/7, no option seller will be making loss. The only reason why the option sellers will make loss is because of the gaps. Right, let's say you have a, right, let's say you have a strangle, let's say you have a straddle or strangle, right. You might have given 100 rupees premium here for your call and 100 rupees for your put. Let's say the next day market gaps up and comes to your call, so this 100 rupees will become 300, right, your call, and maybe this 100 rupees will become only 50 rupees. What is the difference? Almost, see, the current premium stands at 50 and this stands at 300. Right, the moment the market opens, how will you do the adjustments? So this is where you end up as an option seller because of this gap up. Right, threat of an option seller is only gap up and gap down. That's it, friend. If market runs 24/7, no option seller will be making loss. He will be adjusting every 100 points. He will roll up 100 points. Every 100 points down, he'll roll down 100 points call. That's it. He'll balance the trade. No option seller will be making a loss, but the loss will be only with the gap ups and gap downs. This is one of the biggest threat of option seller. If you do not agree with me, comment in the comment section. Let's say we do not. Let's say the market runs. I think the SGX Nifty, right? SGX Nifty. I think that runs almost like 18 hours or 24 hours. I'm not sure. We have only gap of like 30 minutes, like pre-open. So it works in two shifts, right? Shift 1 and shift 2. So between shift 1 and shift 2, you have only 10 minutes break. So if you look at the SGX Nifty, let me show you, friends. Let me show you. Do I have the Obstra? Let me show you the SGX Nifty so that you will get to know. Right, where is my, okay, see, this is important, friends. I'll take you to the SGX Nifty, right? SGX Nifty, let me take to 30 minutes. Okay, I'll just reset. Check, friend. Do you see any gap up? Right, I'll show you. This is the beauty of SGX, because SGX Nifty, see, we very rarely we see this is one area I've seen a gap down. That's it. And throughout it, you do not see any gap up or gap downs, because SGX Nifty runs 24. I'm not sure what 24/7, but it runs like 18 to 19 hours, I believe. Or else I'm not sure whether it runs 24. See, do you see any gap up or gap down, friends? See, just watch with your naked eyes. You do not see any gap up. I'm at 30 minutes, right? See, one gap here. That's it, right? And if you look at this thing, see, there are no gaps. If you're able to find out, that's good, right? No gap. This is the beauty of SGX Nifty. So let's imagine if we had similar kind of market, then no option seller would have made loss. Let me show you Nifty. Right, the same 15 minutes, 30 minutes chart will take and see, and we'll see how many gaps we'll see. See, needless to say, friend, needless to say, see, there is one gap, right? Two gap, three gaps, four gaps, fifth gap, sixth gap, seventh gap, right? Eighth gap, ninth gap, 10th gap. See, 11th, 12th, 13th. This is the way. So these all areas are the threat for option sellers. You got my point? So this you have to see. This is threat for option seller. Gap down, gap down, gap down, gap up. Right? Your gap down. This is the threat of the option seller, because the premiums would change both if you're having two leg strategy. Let's say you put and call. Right? Both the premiums will differ like anything, so you will be not able to manage it. So we do so-called adjustments, and then end of the day either we come up with zero loss or else with very minimal loss, because this gaps is one of the biggest enemy threat for the option seller. Alright, let me take you back to this page. And yeah, and one more thing is like, I mean, even I got some requests from saying that, sir, can we make one video for the V shape market, or half V, or A shape, or N shape, or M shape? See, what I feel is like, yes, definitely this would matter for us, but again, right, doesn't matter what shape you're having, but until and unless the gap, there are like not many gap up and gap downs, you will be able to manage any of the shape market by doing some smart adjustments. Yes, definitely this type of market. So let's say you have a V shape, right? Let's say V shape. So how does this react in this triangle, right? Let's say you started your straddle here, right? V shape is like market fell down, your market is here, and then all of a sudden the market came up again, the market came up, you will be in full profit, right? This way, right? Let's say you have a straddle market, let's take off A shape, right? This one, same thing, market went up, market, your straddle, market went up, so market came here, and within like 1 or 2 days again market came down, it went up and came down, so you are in the middle of this straddle. So what I mean to say is like, shapes of the market doesn't matter, yeah, it has some significance, but end of the day this matters, the threat, that is your gap up and gap downs. Just imagine if you do not have the gap up and gap down, right, then trading would have been altogether a different experience. The way we have seen it in SGX Nifty, there are no gap ups and gap downs. So just imagine how safe the trading would have been, how good experience we would have got with the trading. No gap ups and gap downs. Simple, friends. Just I would rather want, see, there is only one gap, so you can see obvious gap. See, there are no gaps. So just imagine all the retailers in Singapore, they might be enjoying their trading. See, only one gap I see here. That's it. Because even that gaps is only because basically it works in two shifts. Right? Shift 1 and shift 2. So there is like 20 minutes gap or something between shift 1 and shift 2. The moment they started with the pre-open market, so we will find the smaller gaps, not huge gaps. That's it. Maybe 0.2%, 0.1%, 2%. That's it. But when you look at the Nifty, I've shown you, right? Nifty or Bank Nifty, this will see gaps 1, gap 2, gap 3, gap. See, we see all the gaps in our own index. See, those so many gaps. Alright, friends. So let me take you back to this presentation. See, what I've done is like, these are all the genuine callouts from all the viewers. So what I thought is like, okay, let's make a video rather than me commenting in the YouTube, right? So I thought of making a video, right? We got to know, right? Adjustments are very dynamic. Why do we go for adjustment? For mitigating your loss, and for mitigating the loss, and for locking your profit. What are the different adjustments? We have 10 to 15 different adjustments. It's end of the day, your view, your thought, your risk appetite, your trading system, based on that you select your own adjustments. All right, when to do the adjustment, this is subjective. I've shown you. For Friday we have one adjustments, for Monday we do one adjustments, for Tuesday we do one adjustments, for Wednesday we do one adjustments, and for Thursday we do one adjustments. And let me tell you one more thing, friend. See, let's say I have a triangle. This is one of, let's say I have a triangle, right? Sorry, Ironfly, and then market was standing, let's say somewhere here. So then I sold one put, let's say. So now your Ironfly will become something like this. All right, something like this. This is your unlimited loss because you have sold a put from here, and this will become a limited loss. Market was standing here, right? Market was standing here. So let's say market went like on Monday it went here, right? Tuesday it went here, and Wednesday again it came back. It stands at this point, and now your blue line will be something like this. Your blue line will be something like this. Now you should not even exit this trade on Thursday. There is no point in exiting this naked sell what you have done, because the blue line is already giving you the bigger range. The blue line, it's already giving you the bigger range, so you do not even think to exit this extra put you have sold. Because I'll explain you one thing, friend. This is very important. I'm not sure whether you'll be able to get it or not, right? What did we do? We deployed a Ironfly. Right? We deployed, stay with me, friend. This is going to be like very important. We deployed an Ironfly. This was your straddle. Let's say you got 500 points for your put and 500 points for your call. Let's say, friends, this is going to be like very interesting. What happened next day? Market went to your break even. Call said break even. Then to mitigate the loss, you might have sold a put. Let's say for, let's take an example of 100 rupees. Okay, let's take an example of 100 rupees. You might have sold a put of 100 rupees. Market Monday, Friday it went here, Monday again it came here. So this will be giving you profit for sure, because market is going up. Because whenever you sell the put, right, you will get profit whenever the market goes up. Monday, Tuesday, and on Wednesday your market again stands at break even, right? Break even. So now next day market opened Thursday. Slowly the market is coming to your straddle. Let's say the market came to a straddle at 11 o'clock. Now you will be in panic situation, because you will be just focusing on this sell position, because market from your break even, it came to your middle of the straddle, point number one. And if it comes to this zone, maybe not exactly this thing, right? The moment it came to a straddle, so this will start showing you loss 100%. This 100 premium will become maybe 120, all right, or 130. Let's take an example of 120 or 130, but your overall strategy will show you huge profit. Your overall strategy will show you huge profit. Though this will show like 20 to 30 points of loss, but your overall strategy will show you huge profit, for the simple reason being, market from market went here, it came down. Now market stands in the middle of the straddle, point number one, and this is your expiry day, point number two. And the premiums what you got from your straddle is 500 and 500. This would decay like anything, because this has to become zero. This premium has to become zero because today's expiry. This premium has to become zero because today's expiry. Let's say this has become 100 rupees. 500 has become 100 rupees as maybe at 2 o'clock, and even this has become 100 rupees. All right. So how much of premium you got? You got 400 plus 400, 800 premium. Let's say friends, I'm taking the hypothetical example. Let's say you got 800, but you are having only 100 rupees of the extra put. So the 400 plus 400, the 800 premium profit will mitigate the loss of your the put extra sold position. So that's what I said. Even though this is giving you loss, even if the market comes somewhere here, friend, even if the market stands somewhere here, let's forget about this straddle. Let's say the market stands here, and if that is your expiry day, you will be getting good profit. Though this is showing loss, you should not even exit this. What will you do by exiting this loss, right? By that time, right, your this 500 might have given you a decay of 200. This might have given you a decay of 100 rupees. So you will be into profit. Hope I'm able to explain you in the right way. Just try. That's what adjustments are very dynamic. On Thursday, you should not even think to sell a square of this position, because this loss will be mitigated with this premiums, because your market is standing at your straddle point. Meaning, when the market is standing at the straddle point, this 500 and 500, this is big premium when compared to just 100 rupees premium. So this profit, this both leg profit will mitigate your loss, and also that will give you bumper profit if it ends here. If it ends here, maybe you'll get decent profit. If it ends here, maybe you'll get decent profit, but it ends in the middle, then you'll get bumper profit. And whenever the market stands here, we wanted the market to come to our green zone. Forget about this loss about the PE, just because we add a extra put sell position. If market from here, if the market starts coming here, I'll be seeing loss here. That's what many of the retailers will do, but they will not understand their overall strategy will give you huge profit, because this 500 rupees premium will become 100, and then slowly it will become 50, then it will become 0, and this is nothing. This 100 rupees premium is nothing in front of this 500 rupees premium, right? Do not even think about this. We wanted the market to come to our green zone because the actual straddle is here. The actual profit our straddle will give, not this thing, not your 100 rupees, because we wanted the market to trap somewhere here. Alright friends, and shape of the market doesn't make any sense until and unless you do not have any gap up and gap down. Yes, it has some significance. I'll make like other videos based on the shape of the market. So we have different shapes, right? Something like this shape, A shape, V shape, half V, right? Half A. We have N shape. We have M shape. This is very difficult, friend. This M shape will become very difficult, and even this N shape will be difficult. Right? At least this we can manage, but this is critical. Whenever the market stays here, the market goes here, do some adjustment, again the market will come down, again you'll do some adjustment, again the market will trap. That's it. You will end up with loss. This is even more complicated. Market stands here, it goes up, you'll do one adjustment, all of a sudden again it comes down, you'll do one more adjustment, again it will go up, again you'll do it. Definitely you will win to loss. That's what you have to accept. Sometimes you have to accept the loss. Do not do the firefighting. Whenever your stop loss is met, exit from the entire trade and look out for other good opportunities. Firefighting will not help, friends. See, firefighting, definitely it is not going to help you. Rather than doing the firefighting, just exit the trade with your stop loss and look out for new opportunities. Alright friends, so friends, I mean, if you feel like okay, this makes sense, right, or else if you want to add few more points, right, please feel free to add them into the comment section, so that it will be a learning session for me and also for the all the viewers who are watching this video. Let's make it more interactive. I'm okay to take all the negative feedbacks. Honest, I'm telling friends, see, I mean, I basically what I wanted for my YouTube channel is like, see, end of the day, even I'm very new. It's been like 4 to 5 months into options. I might be right, I might be wrong. See, no one is right or no one is wrong in the stock market arena, right? Everything depends on the view. No two people will have the same opinion. For me it is bullish, for you it is bearish. For me it is sideways, for you it is bearish, right? No, I mean, wrong to say that, I mean, either person A is right or person B is right. So what I want is like, just write all your comments. If you feel like I made some mistake, obviously I might be making mistake. Like there are like few comments what I've started getting into my YouTube, saying that there was one guy, I don't want to take the name, but he said watch some ABC video, right, and stop making all the funny videos. I mean, I did not understand. See, in case, rather than putting that comment, right, prove me wrong, saying that okay boss, this is a thing what you're doing wrong, this is a thing what you have to do right. I'll accept that. Yes, even this is a learning curve for me, right? If someone is proving with the data points, saying that boss, whatever strategy you're doing, this is nonsense, or this doesn't make any sense, but at least try to make a video or try to share some document saying that this is way what we have to do. What did I say? Adjustments are very dynamic. What adjustments I do, it doesn't mean that someone has to do the same adjustments, because different market conditions, different thought process, your view is different, my view is different, your price action is different, my price action is different, right? I mean, your adjustments are different, my adjustment is different. You go for intraday, I might be going for positional. There are like so many things. So maybe just try to put more data points rather than just telling that like you are doing wrong, right? Until and unless you prove me with the data points, I'll accept, and I'll also try to correct in the upcoming videos. Alright friends, thank you for watching my video.